we're going to go over options contract chain. We're just going to clearly and go over all of the details about an options contract chain. Okay, this is called a options chain right here. Okay, starting from the top, we're in Webull. So this is the Webull options contract chain. All brokerage options contract chains will look the same, if not very, very similar. Okay, so at the top of your chain, you have a row. All right, on that row, you have the one side is for calls. All right, we know calls refer to the stock price that we are in going up. All right, in the middle column represents the strike price, meaning we're looking at NVIDIA's option chain right now. And NVIDIA is $181.59 today. That's how much one share will cost anyone looking to buy a share of NVIDIA stock. That's what that price represents. To the right, NVIDIA is down 1.57 cent today, which equates to 0.87% of 181.59. So $1.57 down of $181.59 is 0.86%. Okay, that's how much it was down today, not even a percent. The strike price represents the price that you are speculating NVIDIA will go. As you see, all of these prices, okay? Now to the right side of that row, you have puts. Puts mean you are saying that stock price will go down. I'll put you down. So everything, all of the columns on this side of the strike price represents a put. That stock price will go down. Okay. So back to the strike price. Everything derives from the strike price. This column's here because whether you on the right side or the left side of the column, saying you want, so the left side is saying you are speculating that that stock price will go up. The right side is saying you are speculating that that stock will go down. We'll go into detail about this color differential and how this price doesn't seem to match a down. We'll go over that. That means something. The color means something. And you see on the call side, the color, there's a whole group that's colored. That's in reference to this set of strike prices. And this price, strike price, is in this color group is in reference to this strike price on the put side. Put down, call up with those strike prices. Okay, we're going to go over that. So again, first, top row represents one side, is the call side. Middle row represents the strike price, where you speculating that price of that stock will go. And then the right side, put side, down. Call side, up. Okay? So now we get into the next row of columns. Closest to the strike, both sides have the same columns, all right? So closest to the strike is your bid column. A bid column is what that contract, what that stock, NVIDIA contract, which is the strike price. That's why I told you everything derives from the strike price. So your contract would be 180 call or 180 put contract. Your contract, if you like 177.50 call, 177.50 put contract, right? So that's your contract, okay? So this bid price represents the price you would sell that contract currently at. The price that this contract is going for currently. The price that you can sell that contract at current moment, okay? Bid means how much I can sell it for. How many people are bidding to buy it from me? Or how much are people bidding to buy the contract from me for? Okay, so the bid price is how much I can sell this contract for. The ask price is how much I can buy that contract for. Okay. Okay. Before we move on, there's a fun fact and a very important thing you want to know about when buying a contract. You want to be mindful about the difference between the ask and the bid. This difference determines your profit, how much profit you get on your contract. As you can see, they're asking, okay, and before I go there, I want you to understand what you're seeing right here, the numbers that you're seeing. It looks like dollars. Well, it is dollars, but they represent it in ones, tens, right? But you have to know, you have to multiply any ask price and any bid price by 100. You have to multiply that price by 100 because each contract, right, a 180 call contract, that's what this is. Each contract allows the purchaser to have the right to buy 100 shares of that stock when you close your contract position. Okay, you have the right. You don't have to buy those 100 shares. You can sell them for the difference that the price has made when you're ready to sell your contract. I'll go over that next. Okay, so that's why we have to multiply the ask and the bid price by 100, because that's how much we are paying for that contract. So we're not going to pay $2.87 for the contract, for the 180 call contract, because it's the call side. I'm saying NVIDIA going to go up to 180. I guess we can get to that now. The colored group is called in the money. Okay, in the money. That means the stock price is currently past the contract price. Okay, so this 180 call contract, if you was to purchase a 180 call contract right now, as you can see, it's in the money because the stock price is at 181. So you're buying the contract at 180, a 180 contract. Most people buy in the money contracts for safety because all of these colored groups represent a lower strike price than the stock current price, meaning that stock price has already passed these strike prices. That's why you're paying more for it, because it's already value in it. So this is saying, so this contract right here, starting at the top, the 170 strike price, they're asking $1,225 to buy this 170 call contract, meaning the price of NVIDIA will go up. So people will buy it at the 170 because NVIDIA is already above 170, 11 points, sitting at 181. So people do this because the stock may come back down as it's coming down now. But people will buy this 170 for safety, saying, okay, I know NVIDIA is going to keep going up, but we got maybe they're accounting for economic news or some turmoil that's about to happen, and NVIDIA may come down. So they're purchasing that safety that NVIDIA will come down, but they're saying it won't come down lower than 170. So I'll purchase this 170 contract because I know NVIDIA is going to go back up. And when it comes down, I don't want to be minus. I don't want to be negative in the hole. So I'm going to buy this 170 call contract that NVIDIA, saying NVIDIA is going to go up, but I'm giving it room to come down, feeling like it's not going to come down more than 170. So I'm safe. I'm not going to be negative in the hole. I'll still be plus. And then before it comes to 170, now it'll do what I said I'm speculating that it will do, which is go up. So that's in the money. The price of the stock has done the contract. It's already done the contract already. The contract is being bought with value in it. It's already up. So as you see, every colored group that's attached to the strike price, all of the strike prices are underneath the current price of the stock. So all of the colored groups that's attached, these are in the money contracts, in the money. Most people buy them again for safety, saying I like NVIDIA to go up, but I'm going to buy it at the price that it has already passed, giving it room to come back a little bit and don't put me too much in the hole before it goes back up. Okay? So that's what people do for. So let's go to the flip side on the put colored block. So I can explain that. Same on the put. We saying the price gonna go down. Anytime you buy a put contract, you saying the price gonna go down. Okay? So look at this contract, 182.50 put. They're asking $232 for this 182.50 put contract. Okay, so look, NVIDIA is at 181. So it's already down under 182.50. So you buying this 182.50 contract saying Nvidia is going to continue to go down, but I want to buy it at this 182 at the higher price with value in it already, because I think it may come up a little bit before it goes back down. So that's why people buy in the money contracts. 185, I'm going higher. I'm buying a contract that is higher than the current price of the stock, which is Nvidia right now. Nvidia is at 181.59. This contract is 185, and I'm saying that I'm doing a put. Nvidia will go down, right? But I'm going to buy a 185 contract because it's 4 points higher than the current price of Nvidia. I'm saying it might come back up 3 points to 184. Even if it come up to 185, I'll be even. I won't owe the market anything, but I am confident that it will go down because I'm buying a put. So once it come back up 4 points and I'll break even, it will go down to satisfy my put. So I'm buying this for safety because I know it may come up for a minute, but ultimately it will go back down. That's why I'm buying the put. So that's what these in the monies represent. And you can go higher, for your put, just giving Nvidia room to come back up if you think it's going to come back up before it ultimately goes down. So that's what in the money is, okay? Out of the money is the price that you're speculating that stock will go to. It hasn't made it yet. So a 182.50 call to the left side here, Nvidia price is at 181.50. It hasn't made it to 182.50 yet. So this is out of the money. Nvidia has to get there. So they're not charging you an extra price because it hasn't made it there yet. There's still room for it not to make it there. So that's why it's almost a little cheaper than anything else, right? Anything in the money, they charge more because you're paying for that comfort and that safety. You're paying that contract already has value in it because the price of that stock already did it. Okay? But out of the money, the price of that stock has to get there. That's why these are white. All of the contracts that is calls, this the call side, 182.50. They still got to go up a point to make it to 182.50. They're asking $148 for it to go up 1 point. 185 price contract, so it has to go up 3 points and 50 cent or 41 cent before it make it to 185 contract, and they're asking $66 for that contract. Okay, so I hope I was a little clear. And then as you see, this white group represents the strike price going down. So it hasn't come down yet. Nvidia hasn't come down yet to these prices, to these strike prices. So they're asking, more feasible prices, okay, for Nvidia to come down $1.41 to come make it to 180. They're asking at $121, okay, for Nvidia to come down to $177.50. They're asking $60, okay, you get it? So it hasn't come down yet. So that's why these are not colored and these are out of the money. That price of the stock has to get there. Okay. All right. So we clarified that. Okay. Sorry. We missed one top row. The expiration date. Every stock and ETF, every contract has an expiration date. Okay, minimum for all stocks, Nvidias, Amazons, all stocks. Minimum is 1 week expiration date. 1 week. Every Friday, stock options contracts expire every Friday. Right? When you're doing an ETF, like a QQQ, a SPY, all of the ETF, VOOs, all of the ETFs, the minimum expiration date is 1 day, that day. So if you purchasing a QQQ on Thursday, expiration date starts on Thursday. 1 day, 1 day at a time. That's how they do ETF expiration dates. Okay? So that's a fun fact right there that you need to know. All right? So now, moving to the next column. The change. Okay? So what percent of this contract has changed? Right? It's changed negative, right? Or as you see on the right side, the put side, it changed positive, meaning that's the money that's in it, right? So this, the put, this contract right here, a 182.50 put, right? Meaning the Nvidia is going to go down from 182.50, this contract. So if you purchase this contract, this contract has changed. You are up roughly 25%, right? You're up. You're plus 25%. If you was in this contract, you're down because you're saying it's going to go up to 182.50, this contract. So the price hasn't gone up to 182.50. It's actually at 181. So you're down, right? So that's what that change, that percent change column means, right? The last column represent how much the contract was going for the last time, okay? So it's going for $148 right now, currently at the close of today, August 13th. Before that, it was going for $149, okay? We have next column, volume, which is great. The volume is excellent. I always look at volume, right? The bid and ask. The important thing when you buy in a contract, you want your bid and ask to not be a far difference, okay? I look for no more than 30 cent difference. No more. That's even big, 30 cent difference. What I mean by this, they're asking $66, okay? And if you buy this contract, it's 185 call contract saying Nvidia will go up to $185. That's what this contract's saying. They want $66 for August 15th expiration date. So 2 days. 2 days for Nvidia to go up to 185. $66. Now, if I got cold feet when I made this purchase, I bought buy, I clicked the buy button, but let's say I got cold feet. Now, I then could immediately sell the contract for $65, taking a dollar loss instantly taking a dollar loss. Okay, so that's what the bid and ask is saying. Now, sometimes the bid and ask be a drastic change. So if sometimes, let's go look up here. So they're asking $705 for this 175 call contract. But if you sold it, wanted to sell it immediately, you can only sell it for $695, losing an immediate $10, right? Which is okay, because I said, you see that? This is a 10-cent difference, visually 10 cent, okay? Because $7.05, $6.95. So the visual difference is 10 cent, right? But times 100, so a $10 difference, okay? You don't want that to be no more than $30. You don't want it to be no more than $20 difference. A $2, $3 difference for small prices is fine, because that determines your profit, okay? If you buying something for one price and you could only sell it back immediately, or when it's time to sell, it's selling for drastically lower than what you paid for it. It's not a good buy. Nowhere in life. It's not a good investment. It's not good. That thing that you buy have to do great numbers for you to profit, right? So that's putting a lot of things against you, and we don't like that. We want to put things for us, right? So that's why I do not enter a contract that has a wide more than 20 cent, more than 2 cent, more than 3 cent, more than 30 cent difference. Okay, I just don't. Okay, so I wanted to be clear on that. The bid and the ask price difference. All right, we want it to be tight. When I buy something for $14, I want to be able to sell it immediately, or $1 difference, right? That's right up my alley. A $2 difference, or $20 difference on big, that's about the most, right? On big priced contracts, as you can see. The bigger the price, the bigger the delta, the difference, okay? All right, now moving on to the columns. The last, we went through that. Come on, why you got? I hate when they do that. All right. Okay, volume. We love volume. Volume just means, for that contract, how many buyers and sellers are there, right? We want buyers and sellers there. So I do not get in contracts if it's not 1,000 or more volume. It has to be 1,000 or more volume. I need people there for when I purchase the contract. I want to be able to sell it as quick as I can, right? I want people there to purchase that contract. All right, that's volume. Open interest, the same, right? How many people are interested in this contract at open? Okay, you want it the same, 1,000 or better. Sometimes, depending on your expiration date, you might get less volume, less open interest, because it may be far out. Let's say the expiration date that we chose is August 29th, right? The volume and the open interest changes. It might be lower, right? It might be lower. That's because the people haven't gotten in there yet. They're not piled up yet, right? It could grow as the expiration date gets close, I guess is what I'm saying. The volume and open interest. Okay, but 1,000 or more. And if you have a long outdated expiration date, then it's okay. High hundreds, maybe 700, 800, because the interest, the open interest, and the volume will grow as you get closer to the expiration date. All right. Implied volatility. That is drastic moves, right? Drastic movement in that stock price. Okay, the higher the implied volatility, the more riskier that contract is, right? And the drastic the moves could be, up or down, go against you or for you, right? So that's what that implied volatility is. Sometimes it could be great for you, right? If it rolls in your favor, right? Tripling up your profits on that contract. Or sometimes it could go against you, right? Tripling, putting you in the whole triple, right? So the implied volatility is important to be mindful of, right? Okay. The bid size, the ask size, how many people are selling that contract, how many people are waiting to buy it, all right? Your delta, right? Your delta is how the stock price move, how your contract moves in relation to the stock price movement, okay? And you want 30 or more, a 0.30 or more, all right? 0.30 or more, you want it close, you want it to move close as close movement as it can, okay? So if this stock goes up and my contract is a call, I want my contract profits to be moving up close as with the stock price movement, okay? 0.30 or more is great, all right? Anything under 0.30 is slow movement. So the stock price got to move double more for your contract profits to move up, and we don't like that. So gamma is the acceleration of the delta, okay? So it measures how much the delta will change for each dollar move in the stock, all right? If your option has a delta of 0.50, right? And let's say, right here, let's say this contract, right, is your delta is 0.40, which is good, right? Your contract is moving closely per dollar movement of that stock, right? Will push this delta a little to be, let's say, 0.48, closer to 0.50. So it helps the delta. So the gamma helps the delta get closer to the contract moving dollar for dollar with the stock price. The Vega, that's in relationship to your volatility. It measures how much the option price change. Every 0.10 means a 1% rise in volatility increase. Okay, so the higher the Vega, the more sensitivity to the volatility shifts. All right, so the drastic moves of the stock price. Okay, your Theta, this is a time decay, right? So in regards to the contract, so if this NVIDIA stayed in between 181 and 175 tomorrow, all day tomorrow, this time decay will, although NVIDIA is coming to 182, and that's what you bought, the contract, a call contract, that NVIDIA will go up from 181.59 to 182. And tomorrow, let's say what I said, NVIDIA stays between 181 and 181.59 and 181.75 all day. Yeah, it went up points, but it stays sideways. So theta takes away from your percentage. So you're not profiting. You need it to move drastic towards your strike price that you're saying it's going to go to. If it doesn't move drastic or considerable to that price, then theta kicks in and it takes away from your profit. The more time that price of that stock is taken to get to your contract strike price, you lose the value. So you won't gain the profit. It actually loses value. So roll is not used as much. It's tied to the interest rate. It's more relevant for long leaps, for 6 month, 12 month, 18-month contracts. And the break even price NVIDIA needs to get to for you to break even if it doesn't move drastic towards your strike price. But if it moves drastic towards your strike price, you instantly gain value on your contract, right? So you want the stock to move rapid, right? The more rapid the stock moves to your strike price for your contract, the more profits you gain. So it's pretty much, that's it in a nutshell, to be quite honest. All right. And then we get a little more into it. When you're buying a contract, you always want to buy to open order type. So you have market order type, which is whatever the market is asking for that contract. I'm going to pay it. That could be, so when I put this order in, it's asking $66. When the time for me putting it in and the brokerage accepting, price of that contract could have moved up to $70. And if I put in the market, it's going to buy the contract no matter how much the price has changed. Limit, you put the price at what it's saying it want for the contract. When you looking to buy it, you put that price. And the market won't make the transaction unless that contract is at that price. So that's a give and a take, because it won't make the transaction unless it's at that price. But if that price has moved up to $67 when you put it in, your contract that you thought you was in is in the order queue. So you have to be mindful of that too. When you're putting in your contract orders, double check to make sure that it has been accepted. Double check your order queue to make sure it's not sitting in there. And if it is, then you go and edit your limit price to the current price being asked for that contract. The time enforced is for the day. You want it to be there for the day. But if it hasn't been accepted, you can go edit the asking price to get in there, right? Because you don't want to let it sit waiting, unless this is for a week or 2 week expiration date. I can understand. But if you're trying to get in there, you're looking at it to get at a certain level, and it got to that level and you want entry, you want to make sure you get in there, right? Make sure the contracts that you are purchasing is in fact the right contracts, that the number of contracts that you want. Because by default, when we're on Webull, it automatically pops up the 10 contract. Okay? So you want to make sure you're not clicking a purchase on that price and it automatically on 10 contracts. You want to make sure that you select the number of contracts you want, the limit price or market, a stop, right? The stop price that you're willing to pay up until. So that's what that stop is, right? I'm willing to pay, it's at 66 right now. I'm willing to pay up to 67. That ensures that you get into that contract. Stop limit. Okay, you can set a stop loss as well for the price, for less than the price you paid. You can do that, or percentage, which is cool. You can put a 10-15%. I always go with 10-15% for beginners. Depend on how experienced you are, gauge that, but you can put your stop loss in there before you make the purchase of the contract. You're willing to pay $66 to make $30-40 on top of your 66, and you're willing to lose $10. That's pretty good risk to reward ratio. You always want to lose $1 to try to gain $4-5-6. So that's a pretty good risk to reward ratio. Take profit, you can also do that. If I pay $66, if it go up to, the contract goes up to $73, it'll automatically sell it for you. And how we get paid off of contracts, okay? NVIDIA is at 180, 159 on this side, so we're saying it's gonna go up. If we purchase this 185 call contract for $66 in NVIDIA tomorrow, Thursday, August 14th, goes up to 183, 2 points shy about 185, depending on how fast it shot up to that 183. This contract, this 185 contract that we pay $66 for, when NVIDIA is at 183, will then be going for a different price, a higher price. So it'll be going for maybe $100. So now the difference of what you pay for it, opposed to now the bid price that you could sell it for is $105. When you sell to close, right? You sell to close at the bid price. Okay, same thing. You put that bid price in there, and that bid price will be higher than the price that you purchased it for. You selling that contract now for the bid price, which is higher than the ask price that you purchased it for. So that's your money. The difference, that's your money. That equates to the percentage gain that you have earned on your $66. Let's say NVIDIA went up to that 183. Now you bought a 185 call contract. So you saying NVIDIA gonna go to 185, but NVIDIA went to 183 tomorrow. The bid now changed from 65 to 110. Okay, so now that's $110. So now that $66 that you paid, you almost got 100%, because you almost doubled your $66 when you're selling it for 110 now. So you earn between 80 and 90% return on your money. So that's how we get paid. So that's how a stock options contract works. Thank you. Leave a like, a comment. Let me know if there's anything else I could explain. Thank you.